Well, March Madness is here, and you probably filling out a bracket, but filling out that bracket is a lot like picking stocks, right? It feels exciting. You're ready to hit that home run, but the odds of winning big are actually pretty slim. We're going to actually break that down, make that comparison today, and talk about that risky game of picking winners.
Welcome to the My Retirement Clarity Podcast, where our goal is simple, to help you close the gap between what you know and what you implement. The team at Perkins Wealth Management does this by helping good people make great decisions so they can enjoy an amazing retirement. And now, here's your host and financial advisor, Lee Perkins.
Welcome into My Retirement Clarity. Glad to have you on the show. Ben George with Lee Perkins. He is owner and financial advisor at JL Perkins Wealth Management. Lee, we're recording this the morning of March Madness kicking off on Thursday. You pretty excited about it? You like this time of year?
You know, I in the past, I have definitely been more excited about it than I have in the last few years. I just haven't followed it as much as I probably used to. Now, I do a bracket every year, and I think later today I'm going to meet some buddies over at Taco Mac, and We're going to watch some basketball, or I don't know if that's today or doing that tomorrow, but we're gonna watch some games. I'm using it as an excuse to eat some chicken wings.
Exactly. And Georgia's playing today, so a good matchup with Gonzaga. Who knows? They played pretty well this year, so it's always fun seeing them back in the tournament.
Exactly. Yeah, I think they're an 8-9 matchup, and I think it would still be a pretty good upset if Georgia were to win. But who knows? I mean, Gonzaga is just one of those schools that has been, nobody thinks about them until basketball time. So it'll be fun. It'll be a fun game.
It will be. And with that in mind, we want to talk a little bit about stock picking because it is very similar to the brackets and filling out your bracket because, as you fill it out, you start thinking about the end game and how good things could be and maybe becoming a winner and hitting it big and maybe picking that big underdog that could hit. So want to kind of provide a little context for this conversation because there is a little bit of comparison, and one economist whose name Hendrik Bessenbinder, sounds just like an economist's name, right?
Yes, it does.
He analyzed the returns of 29,000 publicly listed stocks from the period of 1926 to 2023 and made a lot of comparisons between that and the bracket which we're going to run through. But as you know, Lee, this is a big business. $2.7 billion was wagered in 2024. It's pretty crazy how much money's put in this, much like people invest in the stock market.
Yeah, absolutely. And I think just, with the expansion of online betting sort of being legal and all that, there's just more and more money on the table. And there's not any of my money on the table other than just what it costs sometimes if we get into a pool where I might put 10 or 20 bucks into something and just see what happens. But yeah, I'm not doing any online betting on basketball or football for anything. It's certainly not baseball.
Exactly. Well, look, here's the first thing, Lee. Many people are going to guess winners, right? Everybody looks at the bracket, thinks there's some upsets and looking at those mid-major teams to maybe pull it. But the majority of the people that are picking those winners are going to lose money. There's a 1 in 120.2 billion chance of getting the perfect bracket. And so far, it's never happened.
So you're saying there's a chance, right? So yeah, I was kind of funny. I mean, that had never been a perfect bracket because there's always there's a couple of Cinderella stories and very few people are picking those teams, with the exception of the people that go to those schools. So I get that. If you're a no-name university and you're playing Duke in the first round, you're going to pick your team on your sheet. So you got a chance. But after that, it gets a little bit squirrely. So kind of in the comparison to the stock market, I think one of the things that he showed is that most people that pick stocks, they're reducing their wealth rather than increasing it.
Yeah. Because
people just aren't successful doing it on a consistent basis. And so it's kind of interesting to hear people brag about the winners that they've picked. Mm-hmm. What's interesting is they never tell you the loser. So I try to tell my clients, if you hear your, if you hear your brother-in-law or a coworker, it's usually, I always bang on the brother-in-law on this show, but man, more and more it's a coworker that seems to have everybody's sort of opinion of them is really high because of the winners that they've picked and kind of how they do things. Mm-hmm. Boy, these people never tell you what their losers are. So if you've got somebody in your office that is kind of touting, yep, I picked so and so stock when they were at $50 and now they're at $200. Ask them about the ones that they picked that were at $50 that now aren't even trading anymore.
Yeah.
I guarantee you, there's a whole lot more of those.
It's funny you say that because I just think about, when you're hanging out around the office this week and next week, you're going to hear the same thing. Oh, yeah, I picked that 13 seed over the 4 seed, but they're not going to tell you that their brackets in the bottom half of their pool that they're in, right?
Yeah, absolutely. Yeah. I mean, it happens all the time, all the time.
Well, and I thought that was interesting that study did show that most stocks led to reduced, the investors, it led to a reduced value in their shareholder wealth because we just assume, hey, put your money in the stock market and you'll be good. But a lot of that goes back to people trying to pick winners and getting in and out and just over trading, right?
People buy stocks on emotions and they buy stocks on what's going on in the news sometimes, or sometimes they might get a stock tip. I'll take some of the politicians that I could probably call some names here, and they're probably pretty good because they may be getting some true insider information. But the guy at your office is not getting any information that is valid information. So yeah, I would just steer clear of that.
All right, here's another thing. So we know that being successful and sustaining that success when you're trying to pick winners is pretty slim. So here's a comparison. So the NCAA tournament, since it began in 1939, only 5 schools have made the tournament appearances more than half of the time. So that's obviously the ones you think about: Kentucky, North Carolina, Kansas, UCLA, Duke. Those are only 5 schools that have made it at least half of the time the tournament's been in play. And then in the stock market, Lee, this is pretty amazing. Only 31 stocks out of 29,000, 31 of 29,000 were in the database for the entire 98-year period of the market.
Yeah, so you would have to be an incredible stock picker to pick the companies that have been around the entire time. I did a little bit of research, and some of the companies that you might know, GE, sometime in 1892, I think, so they've been around a long time. Coke, 1919, and Exxon, which I think used to be Standard Oil. Those guys have been around since 1913. But there's been a bunch of companies that were here at some point that aren't here now, and there's been some that are really new. They appear to maybe have some staying power. I mean, I hesitate to even mention names on this podcast because people might take that as an endorsement of, hey, go out and buy Microsoft or go out and buy whatever, Apple, because they seem to be doing good right now. Everything does good until it doesn't, and that's really good advice. Everything seems to do well until it doesn't anymore. So I think you're better off being diversified. I usually will. Sometimes I'll draw a picture here in the office bin of an elevator. I'll just draw a square box because I like real simple drawings.
Yeah.
And I'll put one cable over that box and say, hey, this is your elevator, and this is the cable that raises and lowers that elevator. And let's just say that cable is a company. You feel pretty good about your elevator having one cable? Or would you rather that have multiple cables?
Yeah.
Well, I'd rather be in an elevator that's got multiple cables so that if one of those cables breaks, I'm not going to fall to the bottom. So kind of, I'm just making a comparison about individual companies. So yeah, 31 stocks out of 29,000. You got to be really, really good to do that.
Yep. And, very few repeatedly win. And we see this in the tournament, right? I mean, there's only been, I think, a handful of teams in the last 30 years that have won back-to-back national championships. Obviously, we're coming off of that with UConn, but it's so rare that ever happens. And, most of the companies in the market have negative cumulative returns. 50% of them do.
Again, it's why the only people that can successfully time the market and successfully pick stocks are called liars. I've always said that, and I kind of joke around. I'm not trying to disparage anybody, but I think that is the truth. The truth. Money Magazine every year. I think it's Money Magazine. They put the top financial advisor on the magazine every year on the cover of that, and that nobody's ever on there twice. And that's because somebody just got lucky in their fund or whatever they're doing. Had a great year, but they're never in there twice. So that's just why we just don't pick stocks. I mean, I've told a story on the show before about a local bank stock here in Macon where I live, Security Bank. And they were a regional bank, but I think they were headquartered here. And during '07, '08, when the market was tanking, their stock price dropped from 20 something dollars, and it went all the way down to like $7 or $8. And I had some of the gray haired advisors in the office telling me, they said, hey, they're like, hey, boy, you need to go buy some of this. This is a $20 bank stock and it's on sale right now for $7 or $8. And I bought some, and that stock proceeded to go to zero. FDIC came and took them over. And so that is one of the ones that obviously had a negative cumulative return. So, yeah, just steer clear of it. Hey folks, Lee Perkins here. I wanted to tell you about our brand new book called Next Phase: How to Retire in a Year or Less Without Regrets. It's all about helping you prepare for the next phase of your life, whatever that looks like for you. So, if you're ready to make the most of your next phase, or if you're already retired and aren't sure you're doing all you can to get the most out of your retirement, then you'll want a copy of this book. All you have to do is text Next Phase to 478-475-2050, and we'll send you a copy right away. You can also access additional resources and register for one of our upcoming workshops at our website, www.myretirementclarity.com. Thanks for listening. Now back to the show.
Yeah, and you look at another kind of comparison too. We like to pick our favorites in the tournament. I'm sure you and maybe a lot of people and work with might have Georgia at least getting by Gonzaga. But whoever your favorite teams are, you're going to always typically kind of lean into those. And it's much like the market, right? We kind of play the ones that we're comfortable with and we think we know. And it's funny because this economist, the takeaway was that he concluded that investors overestimate the worth of their information. They confuse the familiar with the safe. They have the illusion of being in control, which I think is a great description of how we feel about these things that we are comfortable with.
Yeah. And we look at some of those companies like Apple, and we're like, how in the world could Apple ever go sideways? They're such a mammoth company. I kind of try to play devil's advocate. Do you not think that there's another company that is a startup somewhere that's working on some type of new technology that could possibly take market share away from Apple? Sure there is, because that's competition in the market. And with that one company, or let's go to Tesla. I think Tesla is a great company, but their stock is in real turmoil right now because of the political things with Elon and Doge, and the stock's down a good bit. And a lot of folks are mad at Elon Musk for what he's doing with the government and cutting down on the waste, and they're taking that out on Tesla owners. Now, I've never been a huge fan of an electric vehicle as an alternative to gas, because we're not there from a technology standpoint. But I will tell you this, Ben, I went to Dallas, Texas 2 weeks ago for my daughter's cheer competition, and I rented a Cybertruck while I was there. I will tell you, that is the most incredible vehicle I've ever driven.
Oh, yeah?
It was unbelievable. Now, it was wrapped in an American flag, and this was a couple of weeks before people were setting them on fire. And I was in Texas, so I guess I knew the audience.
Yeah.
And so everybody was stepping out and saluting the car and doing all that kind of stuff and taking pictures. So it's a fantastic vehicle. I didn't choose to rent one with the flag. That was just the only one that they had. So I'm a big fan of Tesla. But that stock right now is really taking it on the chin. So as great as we think any company could be, you're always at risk of something that could happen really politically that could devastate a company. And, if you put all of your money in one company, boy, you're at the mercy of maybe the CEO of that company getting in trouble, having an affair, being in the news, not in a good way. And that stock could crumble.
Yeah, that's a great example for sure. So let's just kind of wrap up there, Lee. I know there's a lot of comparisons. We're gonna take our shots. We're gonna hope for the best, but we need to be prepared if we're trying to pick winners all the time to expect to maybe not have success over time. So what are some final thoughts here for someone that's looking for a successful investment strategy with you, Lee, and trying to look for something over the long term that's going to provide returns?
Yeah, so I understand that people like to sometimes own individual stocks, and they really kind of get a rush out of sort of playing that game. And I tell people, if you want to do that with just a portion of your money, that's fine. To me, it's kind of like going to Vegas. If you go to Vegas and you're going to go and gamble, if the prudent gambler, I don't know if that's a real word or not, but if you're going to go to Vegas and gamble some money, you should plan on losing the money that you take to gamble. If you're going there with your, you've taken a 401k loan and you want to double that money and come back, that's not a very wise decision. So if somebody wants to gamble with, 5% of their money or less than that would be better, just a small portion they want to play around with, that's fine. But if they're my client and they're going to do that, I need to take that into consideration when I put together their plan, because I'm gonna plan on you losing all of that money, because I just want to plan for the worst. I want to hope for the best, plan for the worst. So, and of course, if somebody wants to gamble with a huge portion of their money and they're a client of ours, we're not going to be a part of that. We'll gladly help them transition to another advisor. Fortunately, we've only had to have that conversation once, and then that person reconsidered and said, you know what, you probably have a better grasp on what could happen than I do. And so they wound up not doing that. So yeah, just plan on, if you're going to do it, I'm going to plan on you losing the money, and I'm going to adjust my strategy for you accordingly.
Well, if you want to sit down and talk investing or whatever for your financial plan or retirement, whatever questions you might have, talk with jlp.com. Easiest way to schedule a meeting. And it's a good reminder too, Lee, as you get it close to retirement, as you approach that day, your investment strategy changes, right? And I think that your book offer, the Next Phase book that you have now, kind of talks about that transition.
Absolutely. Yes. A great book really for anybody in any stage of life, Next Phase. And I kind of subtitle it, How to Retire in a Year or Less Without Regrets, because people are just kind of really, really kind of leery of things and not really sure if they know what they're doing a year out. And so it's a great, easy read for anybody that wants a copy of it. Just text Next Phase to 478-475-2050. We'll get you a copy of that book.
All right, very good. Thanks, Lee, for taking us through this, and good luck to you in your brackets and anyone that filled one out. Hope you enjoy the next few weeks. It is a wonderful time of the year, and try to soak it all up. But we appreciate your time as always, Lee. Enjoy this afternoon going out with your friends.
Appreciate it, man. Take care. Hey there, Lee Perkins here. If you're like a lot of folks, you've been listening to this podcast for a long time now. But I've got an important question for you. Have you implemented any of the ideas that we've discussed on the show? If you haven't, what are you waiting on? You know you're not getting any younger. So here's my challenge. Don't just consume the content. Our number one goal for this podcast is to help you close the gap between what you know and what you implement. So if you're ready to implement, take that first step today and visit www.talkwithjlp.com and schedule a 15-minute phone call with one of our advisors, and we'll help you close the gap between what you know and what you implement so you can enjoy the next phase of your life. Now is your time. Don't procrastinate any longer.
Investment advisory services are offered by J.L. Perkins Wealth Management, a registered investment advisor and insurance agency. Information is for illustrative purposes only and does not constitute tax, legal, or investment advice. Always consult with a qualified tax, legal, or investment professional before taking any action.